you price your fund in UK sterling, and the online exchange market is in UK sterling. You do not hedge your exposure to wine. Why is that?
The UK is in a remarkable and unique position of having a very lengthy tradition of buying wines from Bordeaux at the en primeur stage, the first of opportunity to buy the wine in the spring after the harvest. It means in numbers terms that in the UK we are sitting on perhaps 25% of the stock of any one harvest at any given time. And that is way in excess of any other concentration anywhere in the world. So the UK has developed as a hub for wine investment because there is so much of the stock sitting here. It's owned by a very wide range of clients. In other words, the private client base of some of the top UK merchants, Berry Brothers, Justerini and Brooks, Corney and Barrow, Lay and Wheeler, all of those clients with their customer reserves are between them holding an immense volume of wine. So we buy in sterling, we sell in sterling usually, and certainly don't hedge any of the currencies.
In finance, and particularly after the liquidity crisis of 2008, I would assume that a lot of investors may be asking you, but what's the point with the liquidity here in wine? What is the actual liquidity? Can I get out when I want to?
The biggest misunderstanding about wine investment, I think, is that we're not really talking about buying the icing on top of the cake, in other words, the best stock. We're talking about one stage further than that, which is literally, and as an analogy, just the cherries on top of the icing on top of the cake. And when you hold only the very, very best of the production of one part of the world, there is always, on a daily basis, an ability to sell that product at a given price. The price spread you may see quite large, but that happens in the stock market as well from time to time if people are uncertain about an equity. But with wine, there is undoubtedly a price on any given day, and the greatest illustration was that during the crisis, 2009, LiveX, the online exchange, produced a chart showing that they had an increase in volume of trades between beginning of 2009 and August or September of 2009, by which stage things were recovering. And an increase in trades suggests that volume of stock is being transacted, albeit at a slightly lower price. And this should be taken in context with the fact that if you own shares on the FTSE or any other stock market, the reality is you couldn't sell those shares at all because people were not buying. So wine has shown in a major crisis greater liquidity than anything else. But that is only the wine in which we're investing, not wine generally. If you had 200 cases of Chablis at home, you probably still got them sitting there and you have to drink them yourselves. But if you have Chateau Lafite or Latour or Mouton, Margaux, Aubryon, any of the big names, you can find a buyer literally in 24 hours. If you want a slightly higher price, perhaps you might wait a week. So the liquidity argument, which institutions have been concerned about, really doesn't exist. It is possible to achieve returning to cash in a sensible time span.
What is the volume here of the market that you are investing in, and subsequently what's the volume of your own investment vehicle?
Wine of the type that we're talking about, i.e. the top wines of Bordeaux, produce somewhere between £1 and £1.5 billion worth of stock every year which can enter the market. Some will never re-emerge again. But LiveX, the exchange, calculates that there is an estimated between 6 and 8 billion sterling value of wine available to the market at any one time. We are cherry picking, obviously, from that stock, even though all of that is prime and therefore investment grade, potential for capital growth over time. We have suggested that we would cap each raise that we offer at 25 million sterling on the basis that if we can't invest that amount of money within a 3-month period, then it's better not to offer anything further until we've successfully invested it. It's important to note that you could go to the market on any day and spend 25 million, but you'd be paying predominantly the wrong price. What we're saying is if you buy at the right price, we'll make you money. So it is a measured approach, but one that has fluctuated over time. And the greatest illustration was when in 2008, in February of that year, the Hong Kong government announced a reduction of their import duty on wine from 40% down to 0. This followed, by the way, that the year before it went from 80% down to 40%. When it went from 40% to 0, a lot of the market who owned any of the stock believed that they better hold on to it because the price was about to fly. In reality, it proved that the Hong Kong buyers were professional and had always been paying the UK prices, and therefore they weren't prepared to pay a premium at that stage. So there existed about 3 months, from February to April, May of that year, a very difficult environment in which to buy as stockholders held on to their stock hoping for something impressive. When they realized the prices weren't going to change, suddenly the market freed up and stock became available.
Now, Peter, you're buying a commodity. How do you actually look after it? How is the storage organized here and the custody of wine?
Storage of wine, unlike gold or certain other things, whilst it needs security, it also needs another factor, which is perfect temperature and humidity. And therefore storage conditions, therefore the warehouses that we choose, are very important. Within the UK, there are a few specialist bonded warehouses where wine stock sits without having attracted duty or VAT, which the government will charge once the wine is taken out and somebody wants to consume it. There's a very unusual element to this, which is the insurance policy that we have covering all of our stock, which is based on the volume, not on the value. Which means that side by side, a case of Chateau Langebauge 96 at £1,000 and Chateau Petrus 1990 at £30,000 actually cost the same amount each year for storage and insurance at full replacement cost. It's a very strange policy, but as we know, there is no such thing as a generous insurance company. So if the premium is low, it means that the conditions are particularly safe.
The risk is low.
The risk is very low, exactly. We have found equally important as the storage location is the fact that we need to have in place a custodian. And it's part of the turning to professionalism of the wine industry that institutional investors, regardless of how well they know you or how much they trust you, need to see a custodian in place in exactly the same way that they would for any other major investment that they make. We use the Royal Bank of Canada as our custodian, and we feel that they are sufficiently respected in the world that people will invest with us, knowing that both the cash that is put into the investment account and thereafter the stock that is held in the warehouse account is being looked after by a professional organisation.